Imagine opening your trading platform tomorrow morning, knowing something completely different. You only get one trade. That's it. If it wins, you're done. If it loses, you're done. If the perfect setup appears 5 minutes later, you're still done. Suddenly, clicking the buy or sell button feels completely different. Because you're no longer asking, "Can I trade this?" You're asking, "Is this the one?" And that small change can reveal something uncomfortable about the way you normally trade. But there's also a hidden problem. What happens when your only trade loses? Can you really sit there and watch the market without trying to make the money back? And what happens when you don't take anything for 3 hours because you're terrified of wasting your one opportunity? That's where this experiment gets interesting. Imagine a trader with a $10,000 account. Normally, he takes as many trades as he thinks he needs. Some days it's 2. Other days it's 5. On a frustrating day, it might become 8. He doesn't start the morning planning to overtrade. Almost nobody does. He starts with good intentions. He tells himself, "Today, I'm only taking clean setups." Then the market opens. The first setup loses. And suddenly, the plan changes. Now he's looking for another trade. Not necessarily because another great setup appeared, because he wants his money back. So let's change one thing. Tomorrow, he gets exactly one trade. Maximum. The market opens. 10 minutes later, he sees something that looks almost good enough. Normally, he might enter. But today, his hand stops. If he clicks now, that's his entire trading day. So he looks again. The setup isn't terrible, but it isn't perfect either. And for the first time, he notices the difference between a trade I can take and a trade I actually want to take. So he passes. 30 minutes later, another setup develops. This one looks better. It matches his predefined plan. He enters. Let's say he's risking $100. Price moves against him. The stop is hit. He's down $100. Trading session over. And this is where the real experiment begins. Because closing a losing trade is easy compared with what happens next. 5 minutes later, another setup appears. The trader immediately thinks, "This one looks better." Then, "I can't finish the day down $100. Then, "One more trade won't hurt." Notice what just happened. The trigger was the loss. The thought was, "I need to make it back." The emotion was frustration. The decision becomes, take another trade. If he breaks his rule, and that trade also loses, frustration increases. And that can create the next mistake. Another trade. Maybe a larger position. Maybe a lower quality setup. That's the behavioral chain. Trigger, thought, emotion, decision. Result. Next mistake. Without a stopping rule, that chain can keep going as long as the trader keeps giving himself permission to click. But with a one-trade maximum, the decision has already been made. Not after the loss. Before the loss. And that's psychologically important. There is a concept called pre-commitment. The basic idea is simple. You know that your future emotional self may want something your calm self doesn't want. So you restrict your choices before the temptation arrives. It's the difference between saying, "I'll try not to take another trade after losing," and "After my first completed trade, my platform closes." The first requires willpower at exactly the moment you're frustrated. The second makes the decision while you're still calm. But don't misunderstand this. A one-trade limit doesn't automatically make you disciplined. In fact, it can create a completely different psychological problem. Imagine it's now the next day. The trader has one trade available. The market opens. Nothing happens. 30 minutes pass. No setup. An hour. Still nothing. Now he starts thinking, "I only get one trade. I can't miss it." Suddenly, scarcity creates pressure. Every candle starts looking more important. He becomes afraid of using the trade too early, but also afraid of waiting too long. This creates a strange psychological conflict. One part of him says, "Be selective." Another says, "What if the move happens without me?" Now the one-trade rule that was supposed to reduce impulsivity can start creating FOMO. The trader watches a mediocre setup. He hesitates. Price starts moving without him. He thinks, I knew it. The next setup appears. This time he enters too quickly because he doesn't want to miss another one. Same rule. Different psychological mistake. That's why one trade a day isn't magic. It can reduce one type of problem while exposing another. And that's actually what makes the experiment useful. It reveals what happens inside your mind when your ability to act is restricted. Now imagine another day. The trader waits for 2 hours. Finally, his setup appears. He enters. This time the trade works. He risks $100 and hypothetically makes $200. Great. He's done. But then something unexpected happens. 20 minutes later, another setup appears. And this one looks even better. The trader watches price move exactly where he expected. If he had taken it, maybe he would have made another $300. Now he feels regret. And this is one of the hardest parts of any trade limit. You can follow your rule perfectly and still watch a winning opportunity happen without you. Your brain may interpret that as a mistake. But was it? If your rule was one trade maximum, following that rule was consistent with your process. The fact that another opportunity later made money doesn't retroactively make your earlier decision wrong. This is where traders often confuse outcome quality with decision quality. A bad decision can make money. A good decision can lose money. And a disciplined decision can cause you to miss a profitable trade. If you judge every decision by what happened afterward, your rules will constantly change. Today you stop after one. Then you see the second trade win. Tomorrow you allow two. Then the third one wins. Soon you're back to unlimited trading, and the boundary disappears. But there's an even deeper psychological effect of taking only one trade. It makes every urge to trade visible. Think about it. When you're allowed unlimited trades, you don't necessarily notice every impulse. You see something. You click. You lose. You click again. But after your one trade is finished, every additional urge becomes something you have to observe instead of act on. You notice yourself wanting another trade after a loss. That's revenge. You notice yourself wanting another trade because Bitcoin suddenly starts moving. That's FOMO. You notice yourself searching lower time frames because nothing is happening. That's impatience. You notice yourself wanting another trade after a winner because you feel unstoppable. That's overconfidence. The one trade rule didn't create those emotions. It made them easier to see. And that may be the most useful part of the experiment. Because maybe your biggest trading problem isn't your entry. Maybe it's that you have no clear stopping point. So how could someone test this idea without turning it into another rigid trading myth? First, make it a maximum, not a quota. One trade a day should not mean, I must trade today. It means, I cannot take more than one. If your setup never appears, the correct number of trades can still be 0. Otherwise, you'll sit there near the end of your session thinking, I haven't used my trade yet, and suddenly you'll manufacture an opportunity just to satisfy the rule. Second, define exactly what counts as a trade before the session. Don't create loopholes after losing. Don't tell yourself, that was just a small trade, or that one doesn't count because I exited quickly. If you're testing a behavioral boundary, ambiguity makes it easy for emotion to renegotiate the rule. Third, create an if-then plan. For example, if my first trade closes, then I close my trading platform for the session. That is much more specific than, I'll try not to overtrade. Research on implementation intentions has found that specific if-then plans can help people translate intentions into action. You're reducing the number of decisions your emotional future self needs to make. Fourth, journal the trades you wanted to take after your session was finished. This part matters. Suppose your first trade loses. Then you see 4 more setups. Don't take them if you're following the experiment. Record them, but also record why you wanted them. Were you trying to recover the loss? Were you afraid of missing a move? Were you bored? Did you feel overconfident? Did you simply hate ending the day red? Now you're collecting information about your psychology instead of paying the market to discover it. And fifth, don't judge the experiment after one day. Imagine your first day ends with a $100 loss. Then the next 3 setups all would have won. Your brain will immediately say, This rule is stupid. But that's one session. The purpose isn't to prove that one trade creates better returns. The purpose is to observe whether restricting your ability to act changes the quality of your decisions. Maybe you discover you're much more selective. Maybe you discover you're terrified of missing opportunities. Maybe you start forcing your one trade because you feel you have to use it. Maybe you discover that after losing, closing the platform feels almost impossible. Every one of those reactions tells you something. And now we reach the deeper reason this experiment can feel so uncomfortable. For some traders, trading isn't only about making good decisions. It's also about action, the anticipation, watching the candles, clicking the button, being involved. And when you're told you can only participate once, you may suddenly realize how much of your normal trading behavior is driven by the need to do something. That's why just be disciplined often isn't enough. Discipline sounds like you're supposed to win an argument against yourself every time temptation appears. But if you're making that argument 20 times a day, eventually emotion may win one. Pre-commitment changes the structure of the problem. You make the rule before you're angry, before you're excited, before you're chasing, before you're trying to recover a loss. And then you observe what happens when your emotional brain tries to negotiate with it. So what happens when you take only one trade a day? Maybe you become more selective. Maybe you discover how powerful your FOMO really is. Maybe losing your only trade makes revenge trading urges stronger. Maybe you stop forcing mediocre setups. Or maybe you become so afraid of wasting your one opportunity that you hesitate on perfectly valid trades. There is no universal answer, and there is no magic number. One trade isn't automatically better than two. Two isn't automatically better than five. The important question is whether your trading frequency matches a tested process, or whether your emotions decide how many trades you take. Because the real lesson isn't take one trade a day, it's this: decide your boundaries before the market starts negotiating with you. And if taking only one trade sounds almost impossible, that reaction itself may be worth investigating. Because if one trade is finished and you still can't walk away from the screen, the next question becomes much more interesting. Why does doing nothing feel so uncomfortable to a trader? And that's exactly what we'll explore next.